Hi, everybody, and welcome to your second panel of the day on deciphering institutional capital and how to attract it for staking. We heard it from the previous talk. Institutional capital might be the largest incremental contributor to staking in the next few cycles. And here we're going to try to understand what is institutional capital, who are institutional stakers, what do they want, what are their requirements, and how to attract this stake in also an evolving staking landscape. I'm Edouard Lavidalle, I'm the CEO and co-founder at Stakin.com, and I'm here with a great lineup of panelists. Frederick Allen from institutional sales, trading and prime at Coinbase, Lorien Gabel, CEO of Figment, Laszlo Szabo, co-founder and CEO of Kiln, and Parker Poor, head of global at InfStones. And without further ado, here's my first question for the panelists. Who are exactly the institutions involved in staking, and what role do they play in the current staking market?
Let me start that one. Yeah, so I think it's, I'll go first. I think it's important to define what we mean by institutions. I think it's a slippery term. Maybe most people define institutions as whoever's bigger than I am. So it's often very relative. So a VC fund will say, well, I'm not institutional. My LPs are institutional, and they'll say my prime broker is institutional, and they'll say, well, the big banks are, and then they'll say BlackRock's institutional, and then BlackRock, I don't know, they'd say central banks or treasury are institutional. So I think it's like very important to sort of define what we mean by institutional. From running a business perspective, I think it's a customer segmentation issue. So, for example, at Figment, we really have we bucket those into two categories. One would be what we call essentially large token holders. Again, not so well defined, but anyone who controls a large amount of tokens. In the case of 32, or in the case of Ethereum, that would be 32 ETH, which is an easy one. And then token aggregation points, so anyone who has influence or control of other people's tokens. And that's sort of how we verticalize our customer, but I think it's really important, whether you're a protocol or a staking infrastructure provider, to really understand what you mean by institutional, because the term is like not very well defined. I mean, I don't know how you think about Coinbase. Do you call yourselves institutional? Probably not. You think your customers are institutional, right?
Absolutely,
whereas I would say, oh, well, Coinbase is very institutional.
I completely agree. One thing to emphasize on that in splitting those two customer segments in the staking context is the second category that Lorien touched on is the large enterprises who have underlying customers who are staking as well. And there's certain little specific product nuances that they require. For instance, they may be a little bit more sensitive to SLAs of staking validators and product nuances like the configurations of the validators and those types of things.
Okay, so yeah, we got large token holders, large enterprises, and very sensitive to SLAs and this type of things. Who do you see as institutionals as well?
No, I think I kind of agree. Like two main categories: the crypto platforms, exchanges, wallet custodians, and the large holders. Is it like a crypto funds, asset manager, a well, right? It's like an individual that has like 1,000 ETH, definitely could be treated as institutional. And if you look at the platforms, as you mentioned, there's like either the wallets will serve retails, exchanges would do retails and institutions, and custodians would be more on the B2B side of things, right? So serving other institutions through the platform.
I agree. And just to piggyback on that, I think when we look at institutions, there's two buckets. There's the traditional finance way of thinking, which they have done for the last 80 years, and then to your point, the large token holders who got in early in the market, and they're gonna require very different factors in regards to KYCs and compliance and regulatory. And if we don't evolve the staking community, then we're gonna be left behind. And I think it's time for us to evolve and bring them to the table and say, how would you like this to look? And if we're not willing to do that, we're going to miss a big opportunity. So I'm glad it's happening.
Yeah. Maybe there's another definition of institutions, which wasn't it originally the blockchain was supposed to disrupt them?
Yeah, that's true.
I came for the disruption and got a BlackRock T-shirt.
Yeah, it seems like if I have enough ETH and if I'm a big whale, I'm an institution as well, but with different needs than our TradFi friends. What do you think are the requirements and expectations from these different type of institutional stakers?
I can start that off. I think the most, what they really look for, and it's evolved as staking, the staking sector has evolved the last 4 years that, at least that I've been in it, is that all stakers require the most secure and diversified staking infrastructure configuration. So security and then performance as well, so generating those staking reward yields. But the key factor, and now we're seeing more of a demand for it, and we as a staking industry certainly need to focus on, is the reward reporting and the data integrity. Those three key factors for me, for
I think
sure.
for Coinbase, also a big legal team, right?
Big legal team,
Right?
very important.
I agree with you, Frederick, on that. We have reporting has to be top of mind and has to be critical in every aspect of it, whether you're talking to the big four accounting firms who rely on that data, or you're talking to some of the companies here that present very good reporting skills. You have to have it. There are still companies out there that are doing Excel spreadsheets, and that's just not going to fly with the institutions. And if, again, we are not evolving, then we're missing an opportunity.
And it's still super hard to find in the space, right? I guess that's why we hear staking rewards, to find good data, just to, on the 5 largest protocols, to have how much a wallet has been earning block per block on staking, and showing this to the regulator or to his accountant at the end of the year. Yeah, I agree. So definitely data is one. You mentioned security insurance. It comes with trust. And yeah, I guess sometimes they also want to spread the risk. So using, not 1, but 2 or 3 of the largest provider that actually brings security and trust and good data. And last but not least, they sometimes need liquidity as well, right? Well, I'm definitely sure we'll talk about it, but all these ETP, ETF providers that are coming, or even a wallet or platform needs liquidity at the end of the day.
I can touch on that as well. So we had some exciting news last week or the week before, where 3IQ, a very large Canadian asset manager, just announced they're launching a staked ETH ETP product, first in North America, of course. And one of their requirements, of course, for their underlying holders is liquidity. If in an ETP structure, if you have redemptions, and so for staked ETH, with the lockups and unbonding queues of staked ETH, how do you address that sort of product? At Coinbase Institutional, we're not just providing the underlying validators to run that, but we also have a financing business for borrowing and lending, so they can lend to these asset managers overnight, and also liquid staking tokens we offer within custody as well. We're a founding partner of Alluvial alongside the Figment guys, and we have our own in-house liquid staking token, CBETH, as well. So back to the point, those large asset managers can use these different products within the staking context to address those.
Yeah, understanding that buyer is really super important. Generally speaking, if you're at an institution as defined, you're probably pretty risk adverse. Otherwise, you'd be at a startup. So it's they really look at the downside almost more than the upside. So, and it's very tactical. So can you fill out a detailed RFP? Do you have a whole bunch of security information they're going to require, a bunch of certifications, ISO, et cetera? Can they get on the phone with your chief regulatory officer? So having that role, does your cap table look like them? So there's a bunch of little tactical things that are super important for that audience, but remembering basically they don't want to get fired for using you. And if you sort of think that way and addressing their downside fears, it's super important for serving that audience.
Yeah, if I can just jump on the regulatory aspect of things, even if none of the regulators in the world has clear guidance towards staking right now, when you are an institutional player, you need to be able to give a bit of visibility of where you think regulators will put the needle, or and obviously according to different jurisdiction, right? So it's like when they're talking to you, you need to have like a proper legal team or compliance team that actually, again, brings them trust when they decide to stake with you.
Our head of regulatory probably does more sales than lawyer.
That's right.
No.
That's right.
No,
That's
I
right.
agree.
It's all going to be fine, you know.
It's interesting you say that, because when we talk to some of the publicly traded companies out there, one of the first questions they ask is the regulatory, the compliance, the security measures, the private keys, what's in place in regards to X happens or Y happens, what's your runway? And I think staking in general has risen this wave, and when it came crashing down, we needed to adjust. And I think that bull market's coming back, and we better have these things in place when the institutions come back, whether that's a SOC 1, whether that's a SOC 2, whether those different licenses. It's not the wild, wild west anymore. And if you want to take a proactive approach and attract those institutions, you need to do that.
Yeah, we touched down on quite a few points. Those institutions, they have very high requirements from operational compliance, regulatory compliance, data auditability, reporting features, risk minimization, and also diversification as they look to diversify stake among different providers. And they do a lot of due diligence. Legal closes more than sales. How do you see that typical institutional staking journey from the day that an institution starts looking at the opportunity of staking to the day that they actually stake? How are things happening there? How long does it take? What's the experience like?
I think of the non-crypto native institutions, you're still starting at basic 101 education. And staking, unfortunately, is still pretty poorly defined for that audience. This audience knows what we're talking about, but that audience will often think of it as lending or DeFi or something like that. So you really start at first principles and then work your way up from there. I also think it's worth thinking about from a market share perspective if you're trying to decide if you want to serve that audience. And I think someone will correct me on these numbers, but if you look at Ethereum, probably 90+% of wallets are less than 32 ETH, but 80% of volume is wallets with more than 32 ETH. So to think about how you want to serve that audience, which audience you want to serve, and then also, where's the TAM, where's the market opportunity, and then what's easier to serve as you expand? Is it easier to go from a smaller audience to a larger institutional audience, or going the other way? So I think those are like some considerations, either if you're launching a business or from a protocol perspective to think about.
Yeah. To touch on two things that Lorien said as well, the education piece of the staking life cycle can be extremely long. I remember back in the day, 2019, 2020, we were educating.
What do you think your average sales cycle is?
Long time. Even for the crypto native funds, who you would think would be very educated on how staking works. Back in 2019, we were saying to these crypto native funds, you guys own like 2% of this layer 1 stakeable token.
30 or 90 days to 180 days?
Yeah, you need to be staking. But now with the traditional asset managers and traditional hedge funds looking at staking, the education cycle can be extremely long, 6 months, 12 months. But then moving into testing as well and actually executing a stake can be even longer as well. And to Lorien's point, it depends on market cycles as well. Hate to say it, but in a post-FTX world, we've seen the priority of traditional asset managers and hedge funds coming into crypto and testing staking in particular is fallen down the priority list. The other thing that Lorien mentioned as well is the actual staking product. We launched a partnership with Kiln on a partial ETH staking product as well, which is something that's very popular. And as Lorien said, a lot of wallets, whether it's 90%, have less than 32 ETH. So the staking product is really critical on how to execute.
Yeah, I mean, and if you divide institutions by like 3 categories, you would say like the whales, the crypto native, and the TradFi. I would say the whales they can stake through already non-crystal platforms such as Ledger today, and they won't take long to decide, right? It's like they look at the APY, they look at the commission, they check the player in the back end and the stake. if you look at the crypto native, definitely they will be looking more, into what insurance you have in the back end now, like what slashing, anti-slashing policies you have. But still, they will be willing to stake faster than a TradFi player, for example. That, as Lorien said, you need to come back to the basics. Like staking is not DeFi. It's consensus layer rewards and not. There's no smart contract risk in that sense. Most of these players haven't staked yet, and they're coming in the coming months and years. Yeah.
It's so basic, they think you're a counterparty.
Yeah.
Basically. They assume you're custodial just by definition.
That's right.
That's how sort of basic it is.
And what's the role probably being played by wallets also with institutional staking? I heard you launched a new project.
Partially staking, yeah, alongside Kiln. So the importance of the wallet, I mean, the staking flow, you execute a stake through a wallet, through your wallet solution, whether it's a big custodian like Coinbase or a smaller wallet, hardware wallet. So the importance of wallets in the staking flow is critical. You can't execute a stake without the wallets, and therefore for us staking providers as well, we need to partner with these wallets and custodians as well.
Yeah, that's one of the things that I'm very proud of at InfStones is we actually have a drop down in which we partnered with, whether it's Fireblocks, Ledger, the MetaMask wallet, that you can go on the platform and pick the wallet and stake directly through your wallet. So making it seamless for institutions and making it seamless for individuals is crossing that border.
Yeah. So the interface is very important, or being integrated within these interfaces in order to capture institutional stake. Do you see institutional staking evolving through time? And I know there's lots of innovations going on from direct staking, liquid staking, restaking.
I think, yeah, I think this was brought up on the first panel. I think Stan specifically raised the issue about whether this is a feature or a full product set. Is it a feature of custody? Is it a feature of a prime broker? Or is it a separate service provider offering? And to be honest, I think that's still an open question. And where will those decisions get made by the buyer? So will that happen in a trading interface? Will it ultimately happen in a Bloomberg terminal? Will it happen with their prime broker, with their custodian? I mean, in traditional finance, no one interacts with their custodian ever, and nothing happens in that interface, right? Unless you lose a paper stock certificate or something weird. But maybe that's not the case because custody is very different with crypto. So I think that's an open question. We'll have to see that evolves. Right now we have sort of a very diverse ecosystem of independent providers. I think that's good for decentralization. I think it's a really open question about the role of custody and prime brokers playing that going forward.
Yeah. I think the industry has completely changed over the last 2 years. I mean, we weren't talking about restaking or liquid staking just a couple of years ago, and now it's top of mind. And what's interesting to me is the institutions have even came and wanted to have conversations about liquid staking and about restaking and, tri-party agreements when it comes to collateral management. There's many different aspects that are going to fall under staking, and I think there's a lot of opportunity.
A lot of interest, institutional interest from traditional hedge funds in particular about restaking. I mean, liquid staking, the cat's out of the bag, but a lot of interest. And that education cycle on restaking EigenLayer has started the last 6 months for sure.
Yeah.
I mean, you touched on basically ETP and ETF that will be like massive drivers of institutional adoption in staking in the coming years. ETH staked ETP, staked ETF will emerge probably in the coming months next year, and they need liquidity. So borrowing and lending, providing them liquidity at the brokerage level or validated NFT, I think it's a good product for this, and then definitely restaking, right? But they would look at the risk of having an 8, 9, 10, 12% rewards mechanism on restaking is great. But what are the ABS or on top of Ethereum? What are you running as additional validator? Like, do you trust the chainlink? Maybe you trust the Ethereum and chainlink, right? But do you trust the Ethereum and a chain that you don't really know? And it still comes back to are you using the Figment or the Kiln of the world or Coinbase Cloud? You know, it's like, how do you have anti-slashing policies? Do you have insurance? Do you do the data properly? And obviously, you know, restaking is, in that sense, is an exciting opportunity for our customers tomorrow.
So an opportunity they're taking a look at, but keeping in mind the risks behind the operations. And it sounds like we can potentially expect higher yields from these opportunities.
Higher yields?
Yeah.
I mean, on restaking for sure, but to Laszlo's point, I mean, the risk-return equation needs to be emphasized within staking, and particularly restaking, but also to take a step down back to traditional ETH staking. The ETH yield is what, like 4 or 5% now. With the US T-bill at like the same, a lot of people looking at coming into crypto, new net capital, they're like, why would I buy ETH and then stake it to get 5% when the risk-return equation is completely different? Why don't I just buy US T-bills and get the 5% for virtually no risk?
Yeah, that's an interesting point, and I think it's a bank in Japan is actually giving you the option to whether get staking yields or interest on treasury bills. And I don't know if that's public yet, but this just happened in Japan. So I think there are going to be different options, and it's a vehicle that, you know, produces income, and people are going to be able to make some choices. And again, I think the timing is pinnacle for us.
With staking ETFs probably coming to market, staked ETH with restaking options, how do we ensure regulatory compliance, since that's definitely something that these institutions are looking for?
So I can touch on the OSC. As I mentioned before,
we shall be buying you guys lunch.
Yeah.
for taking
in the US at least.
In the US, that's right.
So, but to touch on Canada first, with 3iQ, large asset manager, just launched their staked ETH product. They worked very closely with their regulator, the Ontario Securities Commission. So, to your point, you know, what is the focus on regulatory and compliance? It's working closely. The first step is working closely with your regulator. 3iQ did it successfully up in Canada, in Ontario. Down in the US, we are working closely with our regulators in the SEC, and yeah, we do have a very large and important legal team at Coinbase working through it. But my point is, it really starts by educating and working closely with the regulators about what is staking, you know, what are you exposing the people who are staking, what risks you're exposing them to.
Yeah, I mean, outside of the U.S., specifically in Canada also, we've actually gone to the regulators with an exchange customer to make a presentation to them about staking. Yeah. So that's how sort of, again, tactical and ingrained it can become. I think on the staking ETFs and ETP issue, I think it's really important to think about who might be the winners and losers if those are actually successful. Not just from a staking provider perspective, but probably for centralized exchanges who don't do custody. Probably losers, because people can buy them through their brokerages. So for pure crypto exchanges, probably losers if they become successful. Brokerages who didn't have any crypto offering, probably a win if they become successful. And staking providers, depends on if they use a diversified base or go with one or two. But I think it's just like if they, you know, that's been a result of a lot of the price action has been from, you know, those press releases from BlackRock, et cetera. So I think it's kind of fun to think through the consequences if people are starting to buy Ethereum, and I suppose Bitcoin doesn't really apply here, through those vehicles rather than directly. So I would think for your business, might hurt the exchange business, but be really good for the custody business.
We're all about growing the crypto ecosystem. Right. Yeah, we have something like 100 million retail users on our platform, but growing the crypto industry as a whole is definitely our focus. And to his credit, Brian Armstrong he's lived by that for 11 years now, and he sticks to it.
And any thoughts from an EU perspective?
Yeah, I mean, coming back on ETPs, and even for centralized exchanges, I'm a big lever in on-chain flows, actually. The rewards mechanism, liquidity, if there's liquidity, either pooling or author validator. But the beauty of blockchains is that a regulator can, you know, differently to what happened to an FTX with complete opacity. But what we have seen in other TradFi banks recently is like you could track through a Dune dashboard or through another dashboard like the flow which is happening on chain, right? And yeah, I'm a big believer of like flows being staked and rewards accrue to a wallet, could be segregated, could be pooled, and happening all on chain. And I think regulators will set these standards as a default in the future.
I agree. I think you made a good point earlier about the Stakin Alliance. I think, Frederick, you made it. If you're not involved, from a perspective of the company and talking to these regulators and asking questions and bringing, really successful cases to them and saying, this is what's out there, then you're fighting the uphill battle. And I think everybody on stage has taken the point of, let's go start the communication. Let's start talking about this to get this industry where we think we can get it. So,
thank you. I think we have a few minutes left. Probably a last question for all of you. But as we look into the horizon and the probably next 5 years ahead, always hard to project ourselves in crypto. But what do you think is the most transformative change that staking service providers should prepare for in order to work with institutional capital?
Wow. Do you want to start?
I'll take that one. I think someone said it on the previous deck, optionality. I truly believe you need to have more options, and tri-party agreements when it comes to collateral management, I think is going to be a huge, huge part of our business. That's definitely the conversations we're having right now with hedge funds.
I think, yeah, to touch on that, I think the DVT technology will improve the staking industry as a whole because it'll lower insurance and help bring traditional insurance underwriters into staking. They do exist, they are participating, but not in great size. So new technologies like DVT and OBLs out there in SSV, new technologies like that, I think will be transformative in bringing down or bringing more insurance underwriters into the staking industry, and therefore that risk return of potentially getting is almost non-existent, hopefully. I think that could be pretty big in the future. I agree.
Yeah, I mean, increasing our security policies, even the way we handle validation keys, for example, increasing our insurances, increasing getting more accurate data into the staking environment still, and that's still in many of these chains a big problem. And again, putting a lot of these flows on chain with the risk that it implies, but having the same standards of securities. But yes, I think the on-chain world will win at the end of the day.
Data uniformity and UX still has a ways to go.
You said, sorry?
Data uniformity and UX still has a way to go.
Yeah. Absolutely.
Right. Amazing, guys. Well, I'm very excited to see where the staking space is at today. And thanks a lot for sharing more from your perspective of the institutionals staking. And yep, a few years ago, we were definitely not here. And I'm excited to see what are things going to be in the next few years as we're building the internet bonds, and how do we bring this next billions of dollars into staking, and how do we bring the next billion users into staking. Thanks a lot. Thanks to our panelists.
Thanks. Thank you.